Hi, it's Dale here from the Investment Journey. We're here to do another stock analysis. This time it's Walt Disney, ticker symbol DIS. With all the parks closed, cinemas shutting, merchandise stores shutting around the world, what does this really mean for the Disney business case? What does it mean for the stock? It's already dropped 38%. Today we'll be digging into, is it a good buy or simply a value trap? Today's the 25th of March. If you like the video, subscribe, like and comment. It really helps with the algorithm and helps me to produce more. Thanks a lot. Okay, so we're going to cover the recent news, look at the business overview very quickly, do an impact assessment. What does the virus mean for each of the elements of the business and how does that impact the stock valuation? Okay, so I think everyone's heard the news. This virus is causing chaos around the world. Walt Disney have made an announcement. They're going to shut all their parks and attractions, including cruise journeys. Cinemas are closed, which are featuring Disney studio films, and we've got merchandise stores shutting around the world. It couldn't be a more combined mess for the Disney business case. It's dropped 38%, but is that really enough to factor in all of this bad news? What does it mean for the long term? We're going to dig into that and do some scenario planning. All right, so let's just take a quick look at how Disney generates its revenue. It's got four business segments. Media networks, which comprise about 35% of the total amount. We've got parks, experiences and products, which is actually the biggest segment, and it could be the biggest impacted segment as well. We've got studio entertainment, and then we've got direct to consumer and international. Now that's Disney Plus, Hulu and ESPN Plus. So it's all of those streaming services that have been recently brought together by Disney. So if we take a look at the earnings by segment, we can see that the direct to consumer is actually loss-making at the moment. So whilst it's seen as the big growth engine for the future, at the moment it loses money month on month, and that was predicted to continue till 2024. So this is really bad timing. So the only if we take a look at the growth in each area and the impact by the coronavirus, the likely impact as media networks will be broadly neutral, maybe slightly down. Some of the sports products have been lost by ESPN with the cancellation of some of the sports, but in general it's probably the most resilient of the segments that are actually generating net profit at the moment. Parks and experiences are going to be tremendously hit, and studio entertainment is likely to be hit as well, but probably not as significantly as parks and products. And then of course direct to consumer, although it's losing money, and this is the great tragedy at the moment, it's losing money, but this stay-at-home policy that many countries are employing is probably going to provide a huge boost to Disney Plus. So is that going to create a dynamic that's going to offset this negative news? So let's just take a quick look. So what I've done here is I've done some scenario planning and I've broken it down per segment. Effectively, the media networks, I've assumed that there'll be 90% of existing revenues will be retained in any scenario. We've got the blue lines, which are basically the original as is picture from 2019. Then what I've done is I've impacted a 3-month quarter for media networks by 90%. So that effectively they're only generating 90% of the original, and the 6-month impact the same. In parks, experiences and products, I've actually shown a reduction down to only 10% of the current volume for that particular quarter in revenue, with all the parks being shut. And for studio entertainment, I've reduced that down to basically 30%. And then direct to consumer, I've indicated there'll be a 50% increase against the original budget from last year. So looking at these different scenarios, we can see the total revenue is forecast to drop from 71 to 64 billion with a 3-month impact, and even further down to 56 billion with a 6-month impact. And of course revenue is one thing, but let's have a look at the earnings as well. So what we can see here is is a much more significant impact. So we can see that the resilience of the media networks, but parks, experience and products, more than around half of all of the profit for the year being wiped out if we end up with a 6-month shutdown. And studios entertainment will also have a similarly big impact. Now, direct to consumer international is probably the really most difficult one to calculate here. So I've done some manual adjustments here. So I've effectively created a curve that says there'll be growth within this particular segment, but as the growth happens, the loss per unit of revenue will decrease over time. Obviously, then at a certain point, we'll create it to be profit making, but based on Disney's current forecasts, even with an uplift at the moment, we're not going to get to profitability within this period and with this financial year. So what I've really done here is limit the losses by making an adjustment on that trajectory to break even and then future profit. But we can see here that the earnings, dramatically down. A 3-month impact, drops from 15 to 12, and another 3 months from 12 down to 9. So huge impacts on Disney. So I've plugged those into discounted cash flow analysis. I've taken the valuation that I produced for a 10% rate of return, and I've got the intrinsic value at $101. Interestingly, after the 38% drop, it's still $101 actual price at the moment, which is interesting and tells me or indicates to me that there was likely an overvaluation in the market already. When I apply my standard margin of safety, which is my own personal discount factor, I would have a target price with an unaffected Disney business of $71. But if we take those different scenarios and the impact on revenue and earnings, and what I've done is I've assumed that this year the reductions are as per the previous sheets that we've seen, but in the following year we get a bounce, we get 10% growth instead of 5%, and the following year after that we get 7% growth instead of 5%, and then I've got 5% for the next 3 years. That gives us the medium term outlook, and then drop into a terminal value of 3% growth to match the US economy. When I factor all of those things in, the discounted cash flow analysis that I've done has the intrinsic value with a 3-month impact dropping to $77. My margin of safety target price would be $54. And if we look at, I've made a little mistake on the sheet here, a 6-month impact for the COVID virus, then the DCF drops to $71 with a target price of $50. So that's absolutely massive. It would indicate for my own personal choice to buy, I would need something in the low $50 range to give myself confidence that this is a good investment. So it's amazing how such a short-term impact can have a long-term effect on the discounted cash flow analysis. Okay, so that's kind of Disney sat on the hands doing nothing, but I took a look at the balance sheet and the income and expenditure, and also tried to understand what mitigation options could they have. So of course, as they shut the parks, there is an opportunity to reduce their expenditure, running costs and the like accordingly. So they're losing the revenue, but they're also losing some of the cost. So out of the $4.5 billion per quarter of running costs for the parks, experiences and products, I believe that they should be able to achieve a $2 billion per quarter saving during that period. And they can also reduce their capital expenditure in the short term. So every year Disney invests in upgrading the parks, the experiences and developing new products. Obviously they can reduce that temporarily in order to protect their balance sheet, and the $4.8 billion could be reduced to $3 billion to achieve that. One thing I don't think that they can do is I don't think they can defer any production within the studio entertainment business, which you would normally expect someone to be able to do. because they've got to feed Disney Plus, and Disney Plus users are going to expect new and exciting content. I think they're committed to having to spend all of the studio entertainment costs, and so I don't see that being materially impacted by this change, which of course creates quite a high cost burden. And my own personal opinion is they're going to have to dip into the debt market and finance some more debt in order to get the right balance for the business going forward. So then the big question is, can Disney Plus get up and running fast enough and get enough subscribers to be profitable? Disney say that it's not going to become profitable till 2024. Some analysts before it came out were suggesting that they were going to price it around the $100 mark. It's actually in some countries, in the UK where I am, they've positioned in at £50, which is, about $65. So they've actually made it much more attractive. So they're making the volume play to compete with Netflix, which is good from generating subscriber base, but not so attractive in terms of pushing to profitability as quick as possible. So on that, they need somewhere between 60 and 90 million subscribers before they break even, probably 60 million closer, and 90 million to reach profitability comparable to their other business segments, where it seems Disney's target operating margins are around between 25 and 30%. So can they get there fast enough? Well, they've signed up by the end of February, they'd signed up 28.4 million subscribers. It's just released in a few other countries, so they're going to get another bump for that. But in my opinion, they're not going to make it into profit this year, and especially with the headwinds that ESPN Plus are going to face with the lack of sport and events to broadcast. I don't think, while I'm very bullish about Disney Plus in the long term, and I think it's a better proposition than Netflix, I don't see this having a material impact on this year, not a positive one anyway. Okay, but taking those opportunities to save money back into the valuation of the business, and also considering the potential growth in subscribers, potentially bringing it closer to break even, but not there yet. What does that do to my DCF? Well, I get a target of $85, and I get for the intrinsic value, and I get a target buy price of $60. So it's still not a buy at the moment, but interestingly, it did dip the other day to $79 in purchase price for a very short period. So I don't think it's unrealistic, which people would have probably laughed a few weeks ago, that it will get to $60, and when it does, then I would be interested, and I'll probably relook at these figures and see if Disney have released any quarterly results to validate some of these assumptions. But at the moment, yeah, I'm on the sidelines yet again, still expecting further price reductions in the market and higher level of volatility as the virus continues to grow. Okay, hope you've enjoyed this. If you have, please like it, please comment, please subscribe. And as with all these things, this is for entertainment and education purposes only. I'm sharing my own research, but you need to do your own research and seek professional advice before making any investment. I don't have any fiduciary responsibility for you, but good luck in your investing, and I hope you really enjoyed the content. Thanks a lot. Bye.